right, looks like the live stream is broadcasting. This is another edition of the Wicked Awesome Report. I'm Patrick Queally, your friend in the mortgage business. Here is your host, joined by my spectacular co-host, Mr. Declan O'Toole from SelectRE Estate. Good morning, Declan. How are you?
Good morning, Patrick. Doing great. How about yourself?
Good. So another edition of the Wicked Awesome Report. We broadcast this every Tuesday and Thursday at 10 a.m. Or 10-ish, depending on the technical difficulties. So thank goodness no difficulties this morning. We're hitting the post right at 10 a.m. So do us a favor, give us a like, a share, a comment, let us know that we're coming through. You can hear us loud and clear, and check out the Facebook page for the Wicked Awesome Report, and you'll be notified. Give us a like there, you'll be notified when new videos do get posted. So we've got a topic today that I've actually seen come up quite a bit, and it's co-signing. So co-signing for a mortgage loan, but really all the information that we're going to talk about today expands beyond just mortgage financing. It's student loans, auto loans, credit cards, co-signing. A lot of people think that's sort of the magic, hey, just sign here and all it is a signature, and
when you're very away.
Difficulty qualifying, that makes everything go away. And it's not really the case. So Declan, I'm sure that you had in your time as a real estate agent, it's come up where a first-time buyer or a young couple looking to buy a house that maybe is a little bit beyond their means. And it's okay. Mom and dad said that they'd co-sign for us.
Yeah, it's good for them. Not always so good for mom and dad.
Yeah, exactly.
It's we certainly have plenty of situations like that, and I suppose it becomes one of those things. Sometimes there's a need for it. Obviously, it's hard. My understanding, I saw a poll was taken. The National Association of Realtors said that 60% of first-time home buyers had a hard time getting the down payment for a mortgage. And being able to basically actually even qualifying for a mortgage. And of course, the majority of those were millennials between 18 and 35.
Yep.
And I'm sure you see that particularly on your side, Patrick, because you're the guy that's trying to get them the loan in the first place.
Yeah. So I guess the warning that's out there is when someone's co-signing, it's not like it was 20, 30, 40 years ago, where literally it's just mom or dad, okay, they'll just sign their name and their signature is worth its weight in gold or whatever. Nowadays, a co-signer, all of their financial data is part of the application. So if you're looking to buy a house and you're having trouble qualifying, mom or dad, which is the typical example, mom, dad, but it could be anybody. It doesn't have to be mom and dad. It could be brother, sister, a friend, So Declan, you could co-sign for me if I'm applying for financing, if I needed help. Okay. So co-hosts are certainly co-signers. Okay. So what happens when that co-signer becomes part of the picture, it's not just their signature. So all of their income, their assets, their credit, all of their financial data has to be reviewed as well, because they're just as liable for that new obligation that's being created as the person who's purchasing the home. So I guess it may be easier for the rest of the call if we just use, the same example throughout. So we'll say, Johnny is the home buyer. And Johnny can't qualify for whatever reason. There's not enough income or not enough credit, or for whatever reason Johnny can't qualify. And mom and dad decide that, well, they'll co-sign to help Johnny buy that house. So pros and cons. So the pros are, certainly for Johnny, that may help him actually be able to buy that home. We have some additional people that are signing that has additional income, assets, and credit, and all the qualification parameters may be met now once that those set of financials come into the picture. So the pro is, well, Johnny gets to buy the house. I think the cons are much more significant, though, especially for a mom and dad. So again, it's not just mom and dad signing on the dotted line and their signature is worth, its weight in gold. The lender is going to be looking at all of mom and dad's financials, so their income, their assets, their credit, And when it comes time to repaying that debt, mom and dad are on the hook just as much as Johnny is. Okay, so it's what's called jointly and severally liable. Okay, so mom and dad and Johnny may have an agreement amongst themselves that, okay, Johnny's going to pay 75% of the mortgage payment. Mom and dad are going to help out with, the remaining 25%, because, Johnny's just out of college, has his first job, income is not quite where it's going to be, a little bit further down his career path. So they decided to help. Great. That's fantastic. But if Johnny doesn't live up to his end of the bargain here and he misses a payment, well, guess what? That late payment's going to be reported to the credit bureaus, and it impacts mom and dad's credit just as much as it does Johnny, because you're jointly and severally liable. So you can't, you can't call the lender and say, hey, Johnny's supposed to pay 75% of the bill and we're paying the other 25%. Quite frankly, the lender doesn't give a crap. Okay, that's the agreement that you have amongst yourselves. That's not the agreement you have with the lender. The lender wants the full payment every single month. They don't care who pays what percentage. One person pays it all or split 50-50 or what. They don't care. They want the full payment every single month.
So Patrick, let's say, for instance, Johnny is making the payments, at least initially,
yep.
Right? What impact might that have on, I suppose, two things. One is, does it have a direct impact on his folks, or I'm Johnny's parent?
Yep.
That have a direct impact on my credit score? And I suppose, second off, let's say I'm looking to buy another home. It's a vacation home. Maybe I'm actually even just moving. I'm downsizing.
Yeah, great question, because that's sort of the unforeseen consequences of doing that. So if mom and dad do co-sign that obligation, and again, it's not just mortgage financing. This is an auto loan, this is student loans, this is credit cards. If mom and dad co-sign, that trade line, that financial obligation, that loan is going to appear on mom and dad's credit report. Okay, just as it does on Johnny's credit report. So it's a financial obligation. They did sign on the dotted line. They are responsible for that financial obligation. So if mom and dad 6 months, a year down the road, they're looking at buying a vacation home in Florida. Okay, they're want to buy a vacation condo down there. They're down there looking at properties. They apply for financing, and lo and behold, the mortgage for Johnny's place appears on their credit report. So mom and dad may have had financial stability, enough capacity to be able to help Johnny co-sign. But when it comes to buying another property, well, that's another mortgage. Maybe now they can't qualify to purchase that next place because they helped Johnny and co-signed on his loan. So there are some potential negative consequences. Now, in a lot of cases, there are some ways sort of through and around that. So if we can prove, so as a lender, if we can prove that Johnny has been making those payments. Now, the fact that the payments are made, that appears on the credit report, and that's shown pretty plainly that the payments have been made. But if we can document that Johnny alone, without any assistance from mom and dad, if Johnny alone actually has been writing that check and Johnny by himself made that payment every single month, at underwriter's discretion, it may be possible to not count that mortgage that's been co-signed against mom and dad when they're looking to buy their next home, or whatever obligation it is that they're looking to enter into.
Patrick, so with that, do you know of any thresholds there? I mean, is it for 12 months, 24 months? How long does it go?
So it's typically a 12-month history. So if mom and dad co-signed 6 months ago and now they're looking for their vacation condo, it's probably not going to fly to exclude that obligation. We need to show that Johnny's been making that payment for at least 12 months. So timing is an important piece to it too. So you got to make sure that the payments are being made on time, and depending on what your future goals are, if you're a mom and dad, what do you have in the future, and how does co-signing possibly negatively impact what you're looking to do. So there's more downside to mom and dad than there is upside. And we were kind of joking, before the call. I guess one of the major upsides for mom and dad is maybe they get Johnny out of the basement, and
Right.
that's enough motivation for them to co-sign to get him into his own place.
Yeah, which makes sense. I mean, at the end of the day, you're helping out your kid. That is the upside, but very little. So the question I have for you too is, so let's say you get into this and maybe things aren't going so well with Johnny. Can you get out of it, or what are your options?
Yeah, so entirely removing that obligation, so not just sort of an underwriting review of paperwork and proving Johnny made the obligation, made the payments for that obligation. If you wanted to entirely remove yourself from that, really the only way to do that is to sort of, in other business language, terminate the contract. So think about a mortgage loan like a contract. So Johnny and mom and dad have a contract with a lender to make those payments for the next 30 years. The only way to remove mom and dad from that contract, you can't just sign a revision to the same contract and exclude mom and dad. The only way to do that is to rip up that contract and start a new one. So that would mean that Johnny would need to refinance and put that mortgage financing in his name alone, or the property would have to be sold. That contract with all three, mom and dad and Johnny, has to be terminated. That's the only way to remove mom and dad entirely from that obligation.
And of course, I'd imagine if Johnny's refinancing the house, he's going to have to be able to show, same idea, he's going to have to show some history that he by himself is able to make those payments, because there's a bank on
that's kind of funny. Not exactly. So as
equity in the home.
Yeah. So if Johnny is in the home and the the credit report shows that mortgage has been paid on time, in order for him to qualify, he doesn't necessarily need to prove that he was making the payments. It's when we want to exclude those payments, we have to prove somebody else has been making them. Okay. So when mom and dad want to qualify and exclude that payment on the mortgage on Johnny's house, to help mom and dad on their next transaction, Johnny has to prove he actually made those payments. But if Johnny's coming to me to refinance, we're looking at the credit report, and there's a satisfactory payment history for at least 2 months. As long as his income and other qualifying parameters work now, he could potentially refinance into his name. So and that brings up another issue, because mom and dad may be aware of all of that. Okay. And it may be the plan that, mom and dad are going to co-sign, but it's really a temporary situation. Johnny's just out of school, started his career expecting to have higher income in, 6 months, a year, or 2 years down the road. And then he's going to refinance and remove mom and dad's obligation. Fantastic plan. I've seen that work out very well a number of times. I've also seen it work out absolutely disaster, okay? Where Johnny doesn't get that raise or that promotion, and mom and dad want to do something else, again, buy that vacation home or whatever, and Johnny has actually been less than great in terms of living up to his obligation. He hasn't made his payments on time, and whether he's just irresponsible or ashamed to tell mom and dad, well, those late payments are impacting mom and dad's credit as well as Johnny's. And now he may not be able to refinance and remove mom and dad. But even if he can, those late payments still appear on mom and dad's credit report, and that's going to impact their score. So again, I think there's more downside for mom and dad, or whoever the co-signer is, than there is upside. There's a lot of risk. So it becomes, I don't necessarily want to say a side agreement, but pretty much all parties have to agree and monitor, because mom and dad are co-signing. They're going to want to see those bills every month. They're going to want to have a login to the online account wherever, whoever's servicing that loan, to verify that payments have been made on time. Because again, if they're not, it's going to impact their credit. So the ways that I've seen that work successfully is just what I said. You share the online login. So, on the 15th of the month, mom and dad can log in and just make sure that Johnny actually did make that payment, because if he didn't, well, that gives some more time now for mom and dad that they can jump in and make that payment to make sure it doesn't negatively impact their credit. Okay. And I don't want to get into all the family dynamics, but that's typically what I see working best. Again, it's not a side agreement or a side contract, but all parties involved are just having an open discussion and agree that because of the financial obligation that's being created here, they're going to share information. Mom and dad are sticking their neck out to help Johnny purchase the home. I think it's only fair for Johnny to go and prove to mom and dad that he's making that payment every month, so it's not going to negatively impact their credit.
Patrick, do you see the banks, if they're looking at you're looking at a loan and then they see that there's a co-signer on it, do you see them take second take? Because I imagine, given that Johnny's not telling his parents, because they're not the ones actually making the payment, but it makes it slightly more of a chance that this loan is not going to get satisfied.
Not necessarily. So, with the credit reports, we can tell there is a code on the credit reports that tell us whether that obligation is owned by that individual borrower. So we pull Johnny's credit report. We can tell if that mortgage loan or student loan credit card belongs to Johnny individually, or if someone else had co-signed, or if he co-signed for somebody else. So if we take a look at mom and dad's credit report, we can see that that is a mortgage account that they co-signed on. Okay. And when it comes to credit cards, there's also another category called an authorized user. Okay. And I see this a lot with younger individuals that are trying to build credit. Okay. So mom and dad have had an Amex card for 30 years. Okay.
Yep.
Perfect payment history. They're trying to help little Johnny, build his credit history. So they order an additional card in Johnny's name. Now it's mom and dad's account. It's just a third card. So mom has a card, dad has a card. This is a third card for Johnny that's tied to that account. And we can see on the credit report that he's not actually the owner of that account. He's an authorized user. Okay. So with an authorized user, believe it or not, if Johnny's applying for mortgage financing himself, if he's not an owner on that Amex account, if he's just an authorized user, we can totally ignore it. So it doesn't matter in that case if mom and dad have a $50,000 a month bill. He's an authorized user. It's not his account. He's not financially or legally responsible for making those payments. Mom and dad are.
Right.
So that's different than a mortgage where everybody signs, everybody is jointly and severally liable.
Okay. So, all right, interesting.
Yeah,
so,
and again, it's auto loans. Obviously I'm in the mortgage industry, so that's my area of expertise. But it's not just mortgages; it's auto loans, student loans. And I've seen just horrible stories where mom and dad have co-signed for student loans for their kids, and sometimes it's just irresponsibility. Sometimes it's a complete mistake where that student loan was supposed to be deferred because they haven't graduated yet, or they had a longer deferment period they had applied for, and the student loan company is reporting them as having late payments.
Right.
They didn't make, so that's going to negatively impact mom and dad's credit report, and that's probably one of the most common issues that I see come up with co-signed obligations. Student loans just not being deferred properly, and the student or the recent graduate, little Johnny, thinks that everything's taken care of. It's been deferred for a year or 2 years down the road, where the student loan servicing company has a different opinion. And that certainly can be a limiting factor. That's having a string of late payments on a student loan, just like with any obligation, is certainly going to drag down your credit scores.
So I suppose when all said and done, just like the title of this episode is, be very careful before you co-sign. You need to know your borrower too, which in this case we're using Johnny as an example, but it's not always somebody's son or daughter. It could be another individual as well.
Yeah, and I've seen siblings, brother and sister, do that. For an auto loan. hey, Johnny's just fresh out of school, trying to buy a car so he can, get a job and commute back and forth to work. Yeah, I'll co-sign for him. And Johnny, again, either being just irresponsible or just, can't live up to the financial obligation, starts missing those payments. Well, that affects that brother or sister, whoever it was that co-signed for them. Again, it's jointly and severally liable. So I guess what it comes down to, the moral of the story is you have to understand the downsides if you're going to co-sign for somebody. And if you understand those downsides and you're still willing to proceed with that financial obligation, the best thing to do is to have an agreement where you're going to have access to the bills or the online portal or whatever it is, so that you can log in and check and make sure that payments are being made on time. Because if they're not, it impacts you as the co-signer. So it's sort of like that old saying, trust but verify. So trust the payments are going to be made on time, but log in every month and make sure that it has.
Another part of that, the trust but verify, you're talking about the verify part of it. The other part of it is the trust, is maybe if you need to know your borrower too. So again, parents and a kid is one thing. Let's say you are, it's a sibling or a friend. You want to know if that borrower is bad with money, and you want to know if they've got experience with money as well. Yep. And again, as you said, then the verify part of that is you insist on having access to those accounts and that information.
Yeah, exactly. And that, that can alleviate a whole load of problems. So, again, if Johnny, for whatever reason, hasn't made a payment or isn't able to make a payment, well, if you have access to the account, you can log in and, the payment was due 20 days ago, it still hasn't been made. You've only got 10 more days to make that payment before it goes 30 days late and is then reported to the credit bureaus. Puts you as the co-signer in sort of an awkward position. You got to reach into your pocket maybe to pay that bill so that it doesn't negatively impact your credit. And that's sort of the lesser of two evils. Yeah, so you got to come up with whatever X amount of dollars to cover that obligation for the month, so it doesn't negatively impact your credit. It would be a whole hell of a lot worse, in my opinion, if you didn't have access to that online statement and you weren't able to verify it, and that payment did go 30 or 60 or 90 days late, and next thing you know, you've got an auto loan repossession on your credit report. I'd much rather co-sign and know whether or not the person I'm co-signing for is living up to their obligation. And of course, if they're not, that's another difficult conversation to be had as to how to sort that out. Maybe you got to force them to sell the car or to sell the house or whatever it is that they can't financially live up to. Otherwise, you're on the hook for making those payments. And even though you co-signed, you may not necessarily be expecting to make those payments every month. You're counting on Johnny to live up to his end of the bargain.
That's another downside, and I've seen it where somebody, there's a friendship there, right? So yeah. It puts a strain on the friendship if somebody's not living up to their obligations.
Mm-hmm. Yeah, exactly. So whether it be a family relationship or a friendship, so unfortunately, a lot of times when money gets involved, things get weird, and can ruin friendships and family obligations. So, again, I think the moral of the story is, if you can avoid co-signing, do that. If there's no way to avoid it, or you truly do want to do that to help Johnny with whatever it is he's looking to do, trust but verify. Make sure you get those online logins so you can verify, make sure those payments have been made every month. The other way around that is, contributing financially. So maybe, rather than co-signing, getting Johnny some extra money so they have a larger down payment. So the loan amount they're looking for is less and they can qualify on their own. Again, when we're sort of weighing the decisions here, you want to help Johnny, co-signing or helping out with some money to help him with a lower down payment or with a larger down payment so he's borrowing less dollars. that may be a more attractive route to go. But
as long as he still qualifies. But I've seen that a lot.
Yeah.
Certainly, again, also parents are, where they'll help out somebody, young couple getting married, moving into a house.
Yeah, I see it happen all the time. And again, it's viable, it works, but there certainly are risks, so I keep coming back to it. But I think the moral of the story here is just, if you're going to co-sign, understand the risks and trust but verify.
And don't ever give a loan to a guy named Johnny.
Yeah, exactly. John. So sorry if there are any Johnnies watching, but you just may be bad news. So not trying to throw you under the bus, Johnny, but that's.
I give it to Jimmy instead.
Yeah, exactly. Yeah, Jimmy might be a better bet. All right, so that's all that I had talking about co-signing and so the risks, the pros and cons, and what to watch out for. Some questions from you, Declan. That was great. Anything you want to add on as we wrap up?
No, I think we've covered it. I mean, it's pretty straightforward. It's just, again, as you said, trust but verify. Know what you're getting into, and as you said, sometimes you may not have a choice in the situation, but certainly wouldn't run in there with blinders.
Yeah, exactly. It's more than just a signature. It really is a financial obligation that co-signer is undertaking. So again, trust but verify. That's the moral of the story here. So this has been another edition of the Wicked Awesome Report. Thank you, everybody, for tuning in. Patrick Queally, your friend in the mortgage business, joined by my co-host, Declan O'Toole from Select Real Estate. We broadcast every Tuesday and Thursday at 10 a.m. So please give us a like, share, comment. Check out the Facebook page, Wicked Awesome Report. Give us a like over there. You'll be notified whenever new broadcasts are available. I think that's really all that I had for today. One other thing, if you do know of somebody that is a small business owner that has a story to tell, always looking for guests to come on and join us. Doesn't need to be a real estate specific or finance specific company or industry. Just looking for interesting people to have a story to tell that we can.
Particularly, Patrick, with the reopening, etc. It'd be interesting to see what their struggles are, what they have to go through and what their experience is. What if they're getting their business back. So restaurant owners, even small business owners in offices. I'd be curious to see what they have to say. Yeah,
I think there's going to be a whole hell of a lot of stories out there. Some tremendous successes, and unfortunately some failures as well. So be interesting to talk to some people on both ends of the spectrum. So if you fit that category, if you know somebody who does, please drop us a comment, tag them, send us a private message. As you can see here, it's not no attack pieces. It's not hard-hitting journalism. Just a couple of friends chatting over a Zoom call. So again, if you fall into that category, please let us know. If you know somebody that falls into that category, let us know, send us a message, and we'll set up a time to chat to them.
Otherwise, we'll see you on Thursday.
Exactly. We'll see you on the next edition of the Wicked Awesome Report. Until then, hope everybody stays well and stay awesome. Take care. Thanks, Declan.
Thanks, Patrick.